Okay, so picture this. You have a massive company. I mean, hundreds of properties all across the country. It's a major player on the stock market, a name that's been around for decades. And then, one day, it just vanishes. Poof, gone, wiped off the map. This isn't some hypothetical story. It's the real, honest-to-goodness story of AlerisLife.
So, how in the world does that happen, right? How does a company that big just cease to exist? Well, the 25-year saga of AlerisLife is so much more than just a business story. It's really a cautionary tale about some super risky deals, some deeply hidden flaws, and a financial structure that, you could argue, was built to fail from the very beginning. To really understand the end, we have to go all the way back to its very unusual beginning. See, this company wasn't born from some grand vision in a garage. No, it was born out of a crisis, inside a very specific and powerful type of company, a real estate investment trust. And that origin story, well, it pretty much sealed its fate from day one.
So think of a REIT as a giant landlord. They love owning buildings, but they absolutely hate running the messy businesses that are inside them, especially something as complicated and risky as healthcare. So way back in 2000, when a REIT called S&H had a whole bunch of its senior living tenants go bankrupt, it was a total disaster. Suddenly, they were stuck operating these facilities themselves, which is the one thing a REIT never, ever wants to do.
So, what was their solution? Well, they literally invented a company to fix their problem. Five-Star Quality Care wasn't founded to revolutionize senior care or anything like that. Nope, it was a corporate tool built for just one purpose: to take over S&H's failing properties and just manage them. And that mission, to serve its landlord, would end up defining its entire life. And they moved fast. By 2001, S&H spun Five-Star off into its own publicly traded company. This is a classic financial move, right? You wall off the risk. S&H gets to be the safe, stable real estate owner, while Five-Star has to take on all the messy operational headaches. Even back then, the new company could see that government-funded nursing was a tough business, and they were already planning a shift toward more stable, private pay clients. With that foundation set, the new company didn't just stabilize things, it slammed its foot on the accelerator. Under CEO Bruce Mackey, Five-Star went into this era of aggressive, debt-fueled expansion, all of it powered by this deeply symbiotic and, as it turns out, incredibly dangerous relationship with its old parent, S&H. The growth model was pretty simple, and, for a while, it was brilliant. S&H, the landlord with all the cash, would fund the acquisitions. Then, Five-Star would sign what's called a triple net lease. This meant they were on the hook for all the building's costs, maintenance, taxes, insurance, you name it, on top of a fixed rent payment to S&H. It was a growth machine on overdrive, and it turned Five-Star into a national powerhouse. But that model, that triple net lease, it had a fatal flaw. While Five-Star's biggest expense, the rent, was fixed and always going up, its revenues were not. And by the mid-2010s, things like rising labor costs and too many new buildings on the market started to expose the deep, deep cracks in this foundation. And this number shows you just how bad the pressure was getting. In 2016, Five-Star was so strapped for cash that it sold 7 of its own profitable buildings to its landlord, S&H, for over $112 million. Now think about that for a second. They were selling their own assets just to get cash, to pay rent to the very company that just bought them. I mean, the financial loop was closing, and it was a massive red flag. But even after that huge sale, the bleeding didn't stop. The pressure just kept mounting, and by 2019, the company had to issue this absolutely terrifying warning to its investors. Going concern is basically accounting speak for, hey everybody, we might not be able to pay our bills and we could go bankrupt. The whole enterprise was right on the verge of collapse. It all boiled down to one single metric: rent coverage. It's a simple ratio of how much you earn versus how much you owe in rent. A healthy company should earn well over $1 for every dollar of rent they owe. But by 2019, Five-Star had fallen below that critical 1-to-1 mark. They were officially losing money just by opening their doors every morning. The model was broken beyond repair. Now, a Five-Star bankruptcy would have been a total catastrophe for its landlord, S&H. They would have been left with hundreds of empty or failing properties. So to prevent this, the two companies cooked up this massive, painful restructuring in 2019 that completely rewrote the rules of their entire relationship.
And the change was a complete 180. The old risky leases were just torn up. 5-Star went from being a tenant, shouldering all the risk, to simply being a property manager. Its landlord, which was now called DHC, would take on all the financial risk, and 5-Star would just collect a 5% fee for running the buildings. It was a lifeline for sure, but it fundamentally neutered the company. But survival came at a staggering price. To make the deal work, 5-Star was forced to issue so much new stock that its landlord, DHC, and DHC's shareholders ended up owning 85% of the company. The original investors, almost totally wiped out. They were left holding just 15% of a company that was now just a shell of its former self. So now, 5-Star was debt-free, which was great, but it was basically a subsidiary again, totally under the thumb of its owner. Led by a new CEO, Katie Potter, the company attempted one last radical reinvention to try and find a viable future. The new strategy was pretty bold. First, they completely got out of the skilled nursing business, which had been a huge drain for years. Second, they shrank dramatically. They handed over management of nearly half their communities to competitors to focus on a smaller, more profitable core. And finally, in January 2022, they shed the old name and rebranded as AlerisLife, a name meant to sound like wellness and lifestyle, and a future beyond just being a landlord's helper. But the market wasn't buying the new vision. Not at all. The rebrand was immediately followed by a big earnings miss. Just a few months after that, the CEO who championed the new strategy resigned. The stock, which had been trading above $4 on the promise of a turnaround, completely collapsed, and by early 2023, the end was in sight. The company agreed to be bought and taken private for a tiny fraction of its former value. Once AlerisLife became a private company, shielded from the public view, the final chapter was swift and it was brutal. The company wasn't going to be rebuilt, it was going to be systematically dismantled. First, the crown jewel was sold off, Agility, that rehab business that was supposed to power their future. Then came the final blow. Its owner, DHC, terminated all of its management contracts, handing them over to competitors. With its best asset gone and no buildings left to manage, AlerisLife was nothing more than an empty shell. The company announced it was shutting down for good. And here is the perfect circular irony of this whole story. 25 years ago, this company was created for one reason: to manage properties for a landlord who couldn't find anyone else to do it. Now, after all that growth, all that crisis, and all that reinvention, it was being shut down, so those exact same properties could be handed right back to other managers. The cycle was complete. The company was no longer needed, so it simply disappeared. Which leaves us with this one fundamental question. Was this whole collapse just inevitable? Could a company that was created simply to serve the needs of its landlord ever truly be in control of its own destiny? The story of AlerisLife is a powerful lesson that when the goals of a real estate owner and the needs of an operator start to pull in different directions, the entire structure is built on a foundation that is probably destined to crack.